Hello everyone, and welcome back. Today we are going to be talking about a pretty good topic, one that probably a lot of people want to learn more about. You've probably Googled it or something, and now you've ended up on this video, so hello and welcome. We are doing Introduction to Investing, so Intro to Investing. So how do you invest? How does it work? What are the pros, cons? Some things to be aware of, etc. So just kind of a very basic 10 minutes. If you want to get started, a few things to keep in mind. So hello and welcome. This is 10 Minute Money. Please like, comment, and subscribe, and I hope to have you again, or for you to stick around. Whatever you want, you can do. Anyways, so let's talk about investing. What is it? So what you'll do is you will take your hard-earned money and you will put it into a product. Now that product can be something like stocks. It can be bonds, which are a little bit safer. It can be mutual funds. And then you also have ETFs. Those are kind of your big main buckets that you have. So you can invest in stocks, which includes things like Nike, Amazon, Facebook, etc. Okay, so you're investing in an individual company. That's kind of the point, right? So if Nike does really well, the value of the money you put in will go up. If they don't perform well, the value of it will go down. Now, if the value of it goes down, sometimes people get scared because they go, well, what do I do if it goes down? Well, you can either, one, you can wait longer, okay? If you wait, there's no guarantees that it will come back up, okay? Just as an FYI. But you can just wait, and if you think it's a really good, strong company, you can just wait for the value of it to hopefully go up in the future. I've had stocks that are good stocks, they've made me money, but I've had to wait 3 years for the value to go up. So that's why we like a longer time frame when it comes to investing. So you can either wait. If you really like the company, you can buy more. So you can say, oh, this is on sale, I'm going to buy more. So just like if you go to the supermarket, okay, and you see toilet papers on sale and you don't need any right now, but you know you'll need some in the future and it's a good deal, you buy more. So same idea. The third thing you can do is technically sell. So sometimes it's painful, but selling at a loss is actually the right thing to do. For example, if you have $100 and that $100 goes to $90, so 10% loss. It might take you, let's say, 3 years for it to come back up to $100. However, and obviously it depends on yourself, your knowledge, your comfort level, etc. What you can do, and this is very dependent on the situation, is if you sell it and you take that $90, but what if you invest it into another company? So this is company A. So what if you invest it into company B, and then company B after 2 years goes up to $110? Okay, that has been more advantageous, right? Because now you've made $10 net, as opposed to the first option where you made $0 net after 3 years. So the thing is, it's hard to know because you don't know how stock A is going to perform versus stock B. You make your best estimates depending on the knowledge that you have, but things change in the future. So that's part one, stocks. Usually if you're a newer investor, they do say stay away from stocks just because they can be quite risky. Next up, we have bonds. So bonds are fairly safe, okay? And you can get bonds from corporations. You can also get them from governments, okay? So you can get them from like your federal or provincial government, okay? So province of Ontario, province of BC, Saskatchewan, and you can get it from your municipality. So Halifax, Kitchener, Calgary, etc. So you can get it from corporations or for governments. And what it is kind of like a mortgage. So just like an individual, a person has a mortgage and they pay it to the bank, okay? In this case, what happens with bonds is that it's kind of like they owe you money, okay? So you will give them, let's say, $5,000, and you have a time frame, so let's say 5 years. And what they'll do is that every 6 months, I don't have as much space as I thought. every 6 months, they will pay you interest. Now, the amount of the interest depends on the current interest rate, okay? So right now, interest rates are incredibly low, so you're not getting a lot of money, okay? So it depends on what the Bank of Canada says the current interest rate. That's what they base it off of. And what will happen then is after those 5 years or that time frame has passed, they will pay you one last interest payment, and they will pay you the original amount that you have invested, which is $5,000. So bonds are very safe. There's not a lot of movement with their price, okay? You get constant interest, and usually it's twice a year, okay? So you usually have it biannually. Sometimes you can have it more often or less often than that, but that's the general rule that you have. So bonds tend to be fairly safe, and as such, your return tends to be lower than with stocks. So stocks really can vary. I didn't talk about that, forgive me, but you can have something like 7% to maybe 9% annually. But that's assuming that you're investing for a long time. It could be that the first year you invest in stocks, you're down 5%, or you're up 2%, or maybe you're up 25%, depending on the market. So here at 7 to 9%, with bonds, you're looking maybe, it really depends on the interest rates, maybe like 2 to 3% right now is what you'd be getting. So that's stocks versus bonds. And then we have mutual funds and ETFs. Now I do have a video comparing one versus the other, but they're actually quite simple. So I'll give a high level review, and essentially instead of buying 100 shares of Nike, 100 of Amazon, Facebook, Snapchat, whatever it may be, you buy 1 unit of a mutual fund or ETF, and that unit contains all of those stocks. So it could be something like the S&P 500, which is the 500 biggest stocks in America. You can have the TSX 60, which is the top 60 in Canada, etc., etc. So a lot of times for newer investors or for people who don't have the time or don't want to put the energy into investing, mutual funds and ETFs tend to be the golden child. Now they're both similar. Some of the differences include that ETFs, their price changes kind of like a stock does, so between 9:30 to 4, whereas with a mutual fund, their price changes once, which is overnight. And what I like with mutual funds quite a bit is that you can buy partial units. Okay, so if you have something like $500, you can just buy $500 worth of a mutual fund. With an ETF, you can only buy a unit of an ETF. So if, for example, a unit is $63 and you have $500, okay, you would have to do the math and find out how many units or shares you can buy without going over. So you might have a little bit of extra money depending on the ratio or the amount. So I quite like mutual funds. However, with both of them, there are fees associated with it, and these are called MER fees, Management Expense Ratio. Okay, so these can range from quite low, maybe about 0.05%, to on the higher end, maybe like 2 to 2.5%. There has recently been a race to the bottom. Fees are getting lower and lower as certain rules and regulations are coming out and as the government is enforcing more transparency with large corporations. So now that you know some of the main things to invest in, I will quickly touch about different account types. I think I might do a full class on that. This isn't a class, it's a video. So what you can do is that you can open up different account types and invest within them. So you can open up an Rrsp, a Tfsa, or a cash/margin. Okay? And all of these have different pros and cons or benefits to them. So starting with the Rrsp, this one, and then the Tfsa, and then the cash account. So actually, let's start off with the Tfsa account. This one has no taxes, okay? Very important. That's the best thing. There are no benefits to putting money into the account, However, if you make money in the account, you do not pay taxes on them, okay? Even if you take the money out of the account, even if you sell the stock, okay, you do not pay taxes. People keep asking about it, but I promise you, you won't pay taxes. You don't even receive a tax receipt. However, if you put the money in the account and you don't invest, that's actually not that advantageous. It's not using the account to its benefit. An RSP, if you put money into the account, okay, so if it crosses into the RSP account, you do get a tax advantage even if you don't invest with it, okay? So putting money into the account, you do get your taxes back. And then when the money is in the account, it will hopefully grow tax-free. However, at some point in time in the future, probably when you retire, you'll have to take money out of the account, okay? You can't just keep it in there forever, and then you'll pay taxes on the money that crosses and leaves the account itself, okay? So here there's an immediate benefit by putting money into an RSP, and here there's no benefit putting money into a TFSA, but the benefit is no taxes if it grows. And then finally, we have a cash/margin account. These are both non-registered, okay, meaning you do pay full taxes. There's no benefit to you essentially get the worst of both of them. So there's no benefit to putting it into the account like a TFSA, and there is taxes paid on any profits made. Now the difference between the two of them is with the margin account, you can borrow money if you want. You don't have to if you don't want to, but you can borrow money. You pay the interest, but now if you put $1,000, you borrow it and you invest it and it goes up to $1,200, you get to keep the $200, okay? You return the $1,000 and then you just pay the interest. Let's call it $40, okay? So you're still up $160. These are just kind of random numbers that I'm throwing together. So once you decide which account type works for you, for most newer grads or younger individuals, a TFSA and an RSP, some type of a combo of both, a little bit here, a little bit there, works best. And then once you have money in the account, you can decide which combination of products you'd like. It could be a bit of this, it could be a bit of that, it could be a little bit of this. You can do different combinations. So that is a super quick high-level look at introduction to investing, how it works, the different products you have, etc., etc. I hope you learned something new today. I hope you enjoyed the class. Why do I keep saying that? I hope you enjoyed the video. It's YouTube, that's what we're on. Please comment, like, and subscribe. I hope to see you in another video. I took a hiatus. I am back in action. I hope you guys have a lovely Canada Day Actually, I should say, I hope you have a nice day off. We should be aware of what's happening in the world around us. See you in the next video. Ciao for now.